Hello friends, in the earlier video we have discussed something about normally capital market and its importance, characteristics of capital market. Now let us move ahead with the same. So now let us see what are the characteristics of this capital market. So characteristics of capital market is generally it is a new issue market. Secondly, it's a long term market. Third thing is more risk is there compared to the respective money market. And fourthly, here the volume of the market is large, volume of trade is also large, number of investors are also large. And apart from that, normally trade volume per day in all different instruments is also large. So comparatively the market is very stronger compared to the money markets. And now let us see what are the different types of capital market instruments that are there traded in the capital markets generally. The following are the instruments. First one is equity shares. Equity shares generally refers to share in a share capital of a company. So these shares have got normally the following characteristics. First one is it consists of risks, market risks. Second thing is normally the generally shares are traded normally for raising the capital. The idea behind this shares is to raise the capital for the company. So in such case, equity shares normally we find that normally there is nothing called as guaranteed price. So the guaranteed price is not at all possible. Rather, we can find out that the price depends on the performance in the market. It consists of the following risk factor associated with it. First one is normally the risk of low liquidity. So low liquidity means suppose if a stock of Apollo tires now is around 60,000 per market. To get one share, I have to invest how much? 60,000 rupees. Suppose if I want 10 shares, I have to invest 6 lakh rupees. But how much returns I get is perhaps less than 2%, 3%. Depends on normally the market performance. So in such case, I am investing in lakhs, getting in thousands. Please understand, investment is in lakhs and returns are in thousands. That's why I say that normally there is low liquidity in this market. Second thing is normally the high volatility. Market price fluctuations are always observed. So anytime the prices shoot up like anything, the moment normally is something happens there, some external factors, the markets jump down like anything, which means that ups and downs are always observed in the market here. So in such case, there is a risk of high volatility. First is case low liquidity. Second one is high volatility. Third one is there is also a risk of spread, which many times normally what happens is buying price is more and selling price is less. Sometimes selling price is less, buying price is more. So which means that the difference between best buy and best sell gives a spread. So many times normally there is also something called as risk of spread. And one more risk is there affecting this capital market, that is normally the risk of deceptive advertisements. Some of the companies, in order to promote their shares, normally they give lot of advertisement saying that the company is promised to give so much returns, which practically is impossible. Practically giving such returns is impossible. So in such case, the intention is normally just to deceive the investors or to cheat the investors. With that idea, they come across with such type of ads, which again a risk in this particular investment. So equity carries 4 major risks. First one is low liquidity. Second, high volatility. Third, deceptive advertisements. And fourth one normally is risk of spread. So these things are there as far as equity shares are concerned. Equity shares are generally riskier, but it's again a long-term investment, because long-term investors normally they keep the investment in such an equity shares which will grow possibly in larger period of time. For example, those people who are invested in Maruti shares in 80s, today normally there is no doubt that they have made money like anything. Second, Infosys, when it came up normally in the 80s, normally those people who have invested in the stocks of Infosys, today they are no doubt crorepati's. And those people who have invested in MRF shares, at that time they have made money like anything. So those people who have invested in HDFC Bank in 1997, in the period of 22 years, normally their money is more than quadruple, more than 4 times returns they have got. So in such case, normally you can see the equity markets normally are generally good for those who have got time to wait, period to wait, watch the market carefully, understand the analysis of experts, and also generally to wait for a longer period. Such type of investors can do actively in equity markets, one side. Second type of investment in this is normally called as preference shares. Preference shares are normally those type of shares generally like equity, but normally it differs from equity, because in the preference shares normally there are some preferential rights which are given to the shareholders. Preferential rights include right to vote, right to get their dividends, or right to claim their dividends on time. Third one, right to again participate in the annual general meeting of the company. They have also given the right to elect normally their member as one of the board members of the company. So they enjoy these preferential rights. And preference shareholders are generally safer compared to equity shareholders, because generally the investment is long term, and suppose in case if the company is wound up, liquidated or closed down, So what happens is the first claim settlement is going to preference shareholders. Generally their rights are protected. Generally we can find that the preference shareholders get their first claim settlement. Then whatever is left out is given to the equity shareholders. That's why preference share is comparatively advantageous compared to equity shares. Second type. Third one is debentures. Debentures are just like debts. It's also a long-term investment. We find that normally when company wants a larger capital, they invest in debentures. The value of the debentures is normally dependent on how much time we invest, what is the face value and what is the market price, and how many number of years it takes to mature. So if generally if the investment is long term, normally time to maturity is very large, and in that time definitely what happens is normally we find that investors will get more returns for waiting for a longer periods. That is it. Next one is bonds. So bonds are normally called as non-risky instruments. Generally we can find that bonds are normally issued by both private companies as well as normally by the government. Bonds issued by the privates are called as private bonds. For example, we have got IFCI bonds, we have got normally HDFC bonds, and we have also got normally ICICI bonds. These are private bonds issued by the private companies and private banks. So second type of bonds is called as normally bonds issued directly by the government of India, where it is called as public sector bonds. Public sector bonds normally consist of those issued directly by the government. For example, now we have got NHAI bond, National Highway Authority of India bond, REC bond, that is Rural Electrification Corporation bond. So these are normally issued directly by the government. Next, let us see what are the characteristics of the bonds. Bonds generally has got the following characteristics. First one is bonds are normally risk free. No risk is there in investment of the bonds. Second thing is bonds has got minimum face value. Minimum face value of the bond starts with rupees 10 only. 10 rupees only. That is one side. Third one is bonds give you interest. The rate of interest given by the bonds generally is quite higher. That is one side. It is fixed in nature. So on major maturity, the investor will get fixed amount plus interest. That is there. So this is the characteristic of bond.